Here we're going to be looking at a consolidation between the parent and a subsidiary company using the simple equity method, and we're going to be looking at year 2. We've already made a consolidation for year 1 between the parent and a subsidiary, but this is going to be the next year or the year after the first consolidation we made. Now each year the consolidation procedures begin as if there had never been a previous consolidation. So the first thing we have to look at is our investment account here and compare that to our equity account here. So looking at year 2, our investment account for the subsidiary here is sitting here at the end of the year, 12/31, and our equity accounts here are sitting at the beginning of the year of 1/1 or January 1st of the second year. So what we have to do is we have to bring the investment account and the equity accounts in line for the first so they have the same date. So I'm going to bring this investment account back to the beginning of the year or 1/1 date here, and then we also have to be concerned here with the retained earnings account to determine what that is here as of the beginning of the year or 1/1 X2. And this is where we have to go in and we have to make, I'll just go through it and show how we'd make our calculations here to determine the retained earnings for both the parent and the subsidiary based on the January 1st date of year 2. Okay, to determine the retained earnings here at the beginning of year 2 here, or January 1st of X2, that would be the same as whatever our retained earnings were at the end of the first year, or 12/31 of the first year. So looking at our consolidation worksheet here for the for the first year here, we'd have for our parent corporation, we'd have retained earnings at the beginning of year 1 here of $246,000, and then we had internally generated income here, the difference between the revenues and expenses, and that would have been $80,000 in this case. And then we also got 90% of the subsidiary's income in this case, so the difference between their revenues and expenses here was $60,000. 90% times that gives us $54,000. So summing our amounts here, we come up with retained earnings of $380,000 for the beginning of year 2. Now looking at Corporation S, their retained earnings for the beginning of year 2, we again look at the retained earnings at the beginning of year 1 that they had, and that was $140,000. And then internally generated income, the difference between our revenues and expenses here was $60,000. And then they also paid a dividend here, a dividend declared, so of $20,000. So that would be subtracted from the amount here. So summing those amounts here, we come up with retained earnings at the beginning of year 2 of $180,000 for the subsidiary. Okay, to summarize, to determine the retained earnings here at the beginning of year 2 for the parent and the sub, we had to go back to our consolidation worksheet here for year 1. And based on the retained earnings here that were sitting on a worksheet here, plus the internally generated income, and in the case here for the parent corporation and taking its sub amount, we were able to determine the beginning of, or the retained earnings here at the beginning of year 2. And same for the S corporation here, except that there was a dividend involved here. And what I'm pointing out here is to determine the retained earnings at the beginning of year 2, we had to go and we had to take our numbers here off the consolidation worksheet here for year 1 for the parent and the subsidiary corporation. Okay, now looking at our consolidation worksheet here for year 2. We have to bring the investment account here in the subsidiary, which is sitting at the end of the year here, X2 at the 12/31 date, in line with the equity account here, which is sitting at 1/1 or the beginning of year 2 here. So to do that, we have to go in and we have to make our adjustments here to our investment here in the subsidiary, and this is based on the 12/31 end of the year date here. So at the end of the year, we have a $275,400 balance here in this investment in the sub here. And what we have to do is bring it back to $306,000 here. That's what would have been sitting here at 12/31 at the X1 of the end of year 1, which equals the beginning of year 2 or January 1st of year 2. So in this case, the subsidiary here had a loss of $24,000. The revenues here were less than the expenses here by $24,000. So the parent got 90% of that, and that would have been $21,600 here, credited to our investment here in the sub by $21,600. And then the subsidiary also declared a dividend here. Dividend declared here. So go over here, the parent would have got 90% of that here, so that would have been $9,000. Again, credit or reduce the sub account here by $9,000. So now to make our eliminations and adjustments on our worksheet, we just take the credit here for the $21,600 and we would debit that to our adjustment account here for the investment in the subsidiary, and then the balancing entry here would go to a subsidiary loss here of $21,600 for our adjustments, and then the dividend here of $9,000, which was credited to the subs account here, that we would put in and we debit our adjustments here for $9,000, and then we'd also, the balancing amount here would go to a dividend declared here for $9,000. So we've brought our investment in sub back to the beginning of the year, what it would have been worth here in the beginning of year 2, to $306,000. And through these adjustments here, it was sitting here at $275,400. So we did bring it back here to $306,000, the beginning of the year amount. Okay, next looking at the distribution schedule here between the parent and non-controlling interest. We have to eliminate for the parent 90% here of the equity of the subsidiary at its book value here, and we also have to distribute the excess of the fair value over the book value here. Now this distribution schedule, this is sitting here based on the initial acquisition date, but since then the 90% here of the retained earnings in the subsidiary here has changed. So what we have to do is we have to go back to the consolidated worksheet here for year 2 and make our eliminations off that. So looking at first here the common stock of the S Corp, we have to eliminate 90% of that. So 90% of 100,000 gives us $90,000 here. And then the retained earnings as of the beginning of the year, we had calculated that to be 180,000 as was shown down here. So we'd have to eliminate 90% of that, and that would be $162,000. So we would have debited here $90,000 for the common stock here in the subsidiary, and $162,000 here would have been debited to retained earnings. So the balancing amount here would go to credit the investment in the subsidiary here for $252,000. So that would reduce our subsidiary here by investment in the subsidiary here by $252,000. Okay, then to distribute here the excess of the fair value over the book value. $60,000 would go to increase our building account here, and then the balancing amount here would go to credit our investment in the corporation here for 90% of that, or $54,000 here, reduce the investment account, and then the non-controlling interest here of $6,000 would go to increase retained earnings here for the subsidiary. Okay, next to handle our depreciation or amortization. Now that adjustment here is made as of the acquisition date. So sitting at the end of year 2 here, we have to account for both year 1 and year 2 at $6,000 per year. So we would credit or reduce our building account here by $12,000 for the depreciation amount, and then that would be split up here. For year 1, we take a 90-10% split here of the first year's depreciation of $6,000. So retained earnings here for corporation P would be reduced here by $5,400, and then the retained earnings for the subsidiaries amount here would be reduced by $600, and those total up here to $6,000 here for the first year. And then the second year we would increase our building depreciation expense here for $6,000. Okay, what I've shown here is just a basic overview of the consolidation after year 2. Now what we have to remember here is at the end of each year the consolidation procedure is applied to separate accounts of the parent and a subsidiary, and each year the consolidation procedure begins if there has never been a previous consolidation.